Okay, so let's go ahead and get started today. Let me see if I can get this microphone turned around here. Where it will work. Okay, maybe that'll work. Okay. Today, what we're going to do is we're going to start on chapter 4. Probably finish chapter 4. Also, I'm going to give you a chance to vote on the date for your first test. And since it seems like the class is a little smaller than normal, your vote will go further than maybe it would otherwise. Now, the two possible dates that you have to choose from, the earliest would be 1 week from today, which is the February 19th, I believe. And then a second choice would be the following Tuesday, which would be February 25th. It doesn't really matter to me. If we finish the material, finish chapter 4 on Tuesday, we can review some, talk about the test, etc. If you decide, hey, we don't want to have the test till the next Tuesday, then we will probably go ahead and start on chapter 5, and then just have your test and pick back up with chapter 5 and move on. So it doesn't matter to me, okay? So is there anybody, now this is for the in-person class. If you're in the online class listening to this, I've already posted your test dates. So is there anybody who wants to argue for or against one of those days? Thursday the 19th or Tuesday the 24th?
I personally have a test on the 19th, so I don't want to take the test on that day.
Probably start on chapter 5. We'll do a review on this coming Tuesday. What?
Well, okay, if we don't take the test on Thursday and take the Tuesday the 24th, we can review on that Thursday.
Would you prefer to review on that Thursday instead? Okay. Okay. Yeah, we will get it worked out one way or another where we... Now, I'm really confused, but we will get it worked out where we review one day and we take the test at a later date.
We want to review the class before the test.
Okay, the class before the test, so it's fresh on your mind. Okay. You'll have me coming in here the day after the test going, okay, let's review for the test. So confused. Okay, so let's go ahead and vote before I get more confused. How many vote to have the test 1 week from today, which is Thursday, February 19th? Raise your hand. Okay, so, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. And how many vote to have the test on Tuesday, February 24th? Okay, I can stop counting. It's pretty close, though. Actually, pretty close. Okay, that keeps intact the record that I think, I've done this a lot, given a lot of tests, given students lots of choices. Almost always, 99% of the time, if you give them a choice between having a test sooner or later, almost always it's later. But sometimes the vote does sway the other way, but not very often. Okay, so we will finish chapter 4 today. We can start on chapter 5 on Tuesday, and then we will review a week from today, have the test the following Tuesday. Okay? Now, with that being said, chapter 5, which we will start at our next class meeting, that's a really, really, really important chapter. What that means is, please don't sit out thinking, well, I don't have a test for another week. He's just going to start a new chapter today. It's not really important. I'm telling you, it's really important to be here for the beginning of that chapter, okay? Because if you get behind on that, you're going to be in trouble. Okay, so chapter 4, we've talked about all kinds of things. Chapter 1, kind of we're all over the place in terms of introducing finance. Chapter 2, we talked about the operating environment of a corporation. Chapter 3, we looked at financial statements, financial ratios, that type of thing. And then in chapter 4, we're going to look at cash flow, and it's entitled Cash Flow and Financial Planning. Now, as I will talk about as we get into the chapter, very little of what you need to know in terms of the chapter is related to financial planning. The reason for that being that when this book, in a previous edition of the book, there was an entire chapter devoted to financial planning. That was chapter 14. And that made pretty good sense, because in order to understand financial planning, you first need to understand finance. And so, for some reason, they moved it from an entire chapter in chapter 14 to part of chapter 4, which we really haven't had a chance to get into more in-depth finance, which we will start in chapter 5. So there's just going to be a very small portion of the chapter related to financial planning. And most of this chapter, we're going to talk about depreciation and cash flow. Now, one topic that you see here, one of the main topics of the chapter, and what you're going to need to be able to do for the test, is to understand and calculate depreciation. Now, it says here that depreciation is the allocation of the historic cost of an asset over time. Would somebody like to explain that for me? What does that mean in simple terms? The allocation of the historic cost of an asset over time. Okay, so the value of the asset goes down as you use it. Okay, that's exactly right. Does anybody want to? Is that good? Everybody happy with that? I'm pretty happy with that explanation. So what that means is when we purchase an asset for our company, whether we buy a computer or a printer or a car or a building or whatever, we use a portion of that asset each year. Now, the government essentially tells us, and we'll look at this in just a minute, but it tells us what percentage of the asset's cost we can depreciate each year. So sometimes it's supposed to line up with the usage of the asset. Sometimes it does. Sometimes it doesn't quite match up. But that's the way it's supposed to work. Now, the great thing about depreciation is, and you need to know this for the test, it's a non-cash expense. And that's a great thing for us as a business, because that means that we can take that expense, we can reduce our taxable income with that expense, but cash doesn't actually leave our company's checking account. Now, when we pay our company's electric bill, we write the check, cash leaves our company checking account, goes to the electric company. When we pay our employees, cash leaves our checking account, goes to our employees. But when we depreciate an asset, we get to take the expense, which we're reducing our taxable income, and that goes back to chapter 3 in the income statement, but we're not actually reducing what we have in terms of cash. And for tax purposes, we're going to use what's called the MACRS system, M-A-C-R-S. Can anybody tell me what MACRS stands for when it comes to a depreciation system? Okay, MACRS stands for Modified Accelerated Cost Recovery System. Modified Accelerated Cost Recovery System. So you can see why we just call it the MACRS system, Modified Accelerated Cost Recovery System. And this is the method that we're going to use for tax purposes. There are other types of depreciation. What are some of the other methods of depreciation? This is where my accounting students shine. What are some of the other methods? Straight line. Okay, good. Straight line method. What else? The double declining balance method. Okay, good. What else? Anything else? Some of the years digits method. I mean, there are several different depreciation methods depending on what you're trying to accomplish. Because it's not unusual, and we've talked about this a little bit before, but it's not unusual for a corporation to have 2 or 3 sets of financial statements. And that's not illegal, okay? As long as, for example, the one that you're preparing for tax purposes, as long as those are accurate, you may have one set of financial statements for your management team. You may have another set of financial statements for your shareholders. Now, for your shareholders, you want to make yourself look as profitable as possible. For the IRS, you want to look as unprofitable as possible. And we talked about that way back in Chapter 2 when we talked about corporate income tax. And we said if you practice what's called tax avoidance, which means you're minimizing your tax burden, that's completely legal. Tax evasion, on the other hand, is illegal. And when it comes to depreciation, essentially we prefer a shorter depreciable life to a longer depreciable life. And somebody explain to me, why is that? Because what? Actually turn it around. There's more depreciation each year. That's exactly right. So if we have the choice between depreciating an asset over a 10-year period or a 3-year period, we would always want the 3-year period because we can depreciate a larger percentage of the asset each year, which means we're reducing our taxable income. So depreciation, big part of a corporation. Now, some terms that you need to be familiar with. The first one is what's called the depreciable value of an asset. And this formula will be provided for you on your formula sheet for the test. The depreciable value of an asset is equal to the asset's cost plus delivery plus installation. And that's a big benefit for us because if they just stopped at the cost, for some assets, it's really expensive to have those assets delivered. Have any of you been someplace where you see these giant wind turbines? A lot of them out west. And occasionally, if you're on the interstate, you will see a really big truck carrying just one blade of these giant wind turbines. Now, can you imagine how much it costs to deliver the entire turbine? The blades, the body, installing it. Can you imagine how much it costs for that? So if you're, for example, if you're in the wind energy business and you're purchasing a turbine, you're going to depreciate the value of that turbine over a certain number of years. You're wanting to be able to depreciate the cost plus the delivery plus the installation, because that's going to be a huge part of the cost of that asset. Some assets, of course, it's not that important, but for some it is. So the depreciable value. Also, you need to be familiar with the different property classes. Now, let me say this. For purposes of this class, if you're depreciating an asset, and I will ask you on the test to depreciate an asset, I will tell you which class is being depreciated under. For example, I will say we're using the 3-year depreciation schedule or the 5-year depreciation schedule. So you don't have to memorize, what falls into what class. But if you own a business, then when you purchase something, for example, research and special tools, you depreciate over 3 years. If you buy a computer, a printer, a copier, a light-duty truck, etc., you depreciate over 5 years. Office furniture, fixtures, manufacturing equipment, 7 years depreciation. of the petroleum refining equipment, 10 years. And this goes, it just keeps it going, okay? So these aren't the only depreciation classes. These are just 4 of them, the 3-year, 5-year, 7-year, and 10-year. And we can take depreciation out to, and it changes, I think it's 31 years, something like that. It changes from time to time, the maximum amount of years. But if you're taking, for example, a building, then typically that's going to be depreciated over 31 years. Now, let me ask you this while we're talking about depreciation. I just mentioned a building. If you buy, let's say you buy a building, a warehouse sitting on 2 acres of land, and you pay $300,000 for the warehouse sitting on the land. Can you depreciate the entire $300,000 cost of the warehouse? No, why not? Oh, okay, land is not depreciable. Why isn't land depreciable? Increases in value or what? Okay. Okay, so essentially, in the most basic terms, you gave a really good example there. In the most basic terms, land doesn't wear out. Okay? That warehouse is, eventually it's going to start declining, and eventually it's just going to wear out. It may take 10 years or 100 years, but eventually it's going to wear out. Land typically doesn't. So if you pay $300,000 for a warehouse sitting on 2 acres, you have to separate out somehow what is the land worth versus what is the warehouse worth, because you can just depreciate the cost of the warehouse. Okay? Now, if you're doing that, you would want to be as generous as possible in terms of what the warehouse is worth, because that means you can depreciate more. Now, it was mentioned that in some instances, land can wear out. For example, mining purposes. So if you've got land and you're mining whatever, coal, gold, if you're drilling or pumping oil out of it, whatever, that can wear out, and that falls under a different classification. But for most purposes, for real estate, the building or the property can be depreciated. The land can't. Okay? Okay, so 4 property classes, and if we take a look at a depreciation schedule, you can see here, basically these are the first 4 that we just talked about, the 3, 5, 7, and 10-year class. And this tells us for each year what percentage of the depreciable value of the asset we can depreciate. So for example, for the 3-year, we purchase something and it can be depreciated over 3 years. The first year, we can depreciate 33% of the cost. The second year, 45%, the third year, 15%, and the fourth year, 7%. Now, let's back up here, because I just said that was a 3-year schedule, but we're showing 4 depreciation periods. So what's up with that? And if you take a look at the 5-year schedule, you'll notice there are 6 depreciation periods. Or the 7-year schedule, there are 8. Or the 10-year schedule, there are 11. So why do we have this additional small percentage of depreciation for an additional year? As soon as you get some... Okay, that's true. I'm not going to disagree with that. That is true. So how does that fit into this? I agree with you. I agree with what you're saying. And we'll talk more about that in Chapter 5, actually, about purchasing cars and financing cars with loans and how they lose their value. Okay. You'll notice each of these depreciation schedules have an additional period of depreciation. And this is because we use what's called the half-year convention when it comes to depreciation. What that means is, this is assuming that whatever we purchase, we're putting it into use basically on July 1st of an operating year. So 6 months into the year. So what happens is this depreciation schedule carries over from July 1st to June 30th of 1 year. Then July 1st of June 30th, another year. July 1st to June 30th for the third year. And then finally, this little number that we have at the end of each of these, this is the last 6-month period of depreciation. So you'll notice these are really small numbers because by that time, the piece of equipment is basically worn out or fully depreciated, and so there's not just a lot left to depreciate. So because of the half-year convention, you need to remember we always have an additional period of depreciation. And we'll work through some examples of that in just a minute. Now here's an example you can take a look at. We've got our company, let's see, Baker Corporation. It says acquired for an installed cost of $40,000, a machine having a recovery period of 5 years. So it's a depreciation period of 5 years. Using the maker's table, the depreciation expense each year is as follows. Now, we're using this table and we're using these percentages, the 5-year depreciation percentages. So notice the percentages, 20, 32, 19, 12, 12, and 5. And that's what you see here. So that's where these numbers are coming from. And so if you wanted to calculate the depreciation for this particular asset, you simply take the depreciable value, 40,000, multiplied by the first year, 20%. That equals a depreciation expense of $8,000. And so remember back in chapter 3 when we were looking at the income statement and we had something called accumulated depreciation. It was down towards the bottom of your income statement. That is where this depreciation expense, well, that was on your balance sheet, but you would have a depreciation expense on your income statement and you're going to reduce your taxable income, in this case, by $8,000 because of your depreciation expense for year 1. Year 2, it's going to be the $40,000. Now, what some people want to do is they want to take the $40,000, subtract the $8,000, and then start the next year with that amount. That is not correct. We're going to use $40,000 for each of our calculations. So the second year is 40,000 times 32%, or 12,800, and then 19%, 12, 12, 5, and your total depreciation should add up to be $40,000, which should match the depreciable value. Now, in this example, we are ignoring things like salvage value because some assets will have what's called a salvage value. And if you're in accounting, you'll learn more about salvage value. But we're ignoring that. We're just depreciating the entire cost of the asset. So does everybody see where these numbers are coming from? So if you saw this on a test, you'd say, hey, that's a really easy question, and you could work it and then move on. Yes? Because this is what we're basing. The question is, why do we use 40,000 each time? And that's because that's what we're basing our depreciable value on, is our 40,000. And so each year, you'll notice we're taking a different percentage, but the depreciable value, now the depreciable value decreases, but the original cost remains the same. Okay? So, for example, after the first year, this asset's depreciable value or book value would be $40,000 minus the 8, or $32,000. So on the balance sheet, we would show, it doesn't say what this is, just a piece of machinery, we would show machine, $32,000. But in terms of calculating depreciation, use the $40,000 each year. All right, really good question. Other questions about the table? That's all together. So we don't know, the machine could have cost $30,000 and installation and delivery could have been $10,000, but the total installed cost is $40,000. All right. Actually, I'll let you work an example. And I'll go back to the 5-year percentages in just a minute, but it says here that your company, and take just a couple of minutes to work through this if you would please. Your company purchases a piece of equipment for $20,000. Delivery is $2,000, and installation is $3,000. The piece of equipment has a 5-year depreciable life. Calculate the annual depreciation expense using the depreciation table. And so once you get the information down here, I'll flip back to the table. The table is also in your textbook, by the way, in chapter 4. So if we go back here, these are our depreciation percentages. Okay, so I see most of you setting up your depreciation schedule. So your depreciable value for this particular asset is how much? $25,000, okay? The cost plus the delivery plus the installation. And then for the first year, you would simply take the $25,000 multiplied by, here's our percentage, so it would be by 0.2 or 20%. And if we take 25,000 multiplied by 20%, you should come out with $5,000, which is your depreciation expense for the first year. And then the second year, it would be the 25,000 times 32%. So that would be $8,000. 25 times 0.32, and you would just keep going on down the percentages. And the way you can check yourself to make sure you haven't made any mathematical errors is simply add up all of your depreciation each year. It should equal, in this case, $25,000. If it doesn't, then you have made a mistake at some point. Yes. You will, yes. You will give you. I will give you this table exactly like you see it here. Also, back in chapter 2, we have the tax table, so I'll give you that. So you'll just have a photocopy of this. Yeah, so don't worry about memorizing the percentages or anything. Just know how to calculate. Now, with depreciation, of course, with the example that I just gave you, I asked you to calculate each year. On the test, of course, since it's multiple choice, I really can't do that. And so, a question might be based on this information. I might ask you, what is the depreciation expense for year 3? So you need to know, okay, I need to take $25,000 multiplied by 0.19 to come up with the depreciation expense for year 3. Or what is the depreciation expense for year 1 or for the first 2 years? So you need to be able to, do it for the 20% and the 32%. Or if I ask for the 7-year schedule. But I think you get the point. So is everybody, you pretty comfortable with depreciation? Pretty simple? Yes? Okay, depreciation is a topic that a lot of times, if you just run through it really quickly, it can be a little bit confusing. Okay, some of this I'm just going to go through pretty quickly. This is talking about what's called a Section 179 deduction. And the reason I bring this up is because some of you you may have a small business that you run. It could be, you know, a lawn mowing business. You might have a computer repair business, and I don't know, you know, whatever you might have. But if you have a small business and you meet certain qualifications, and they're actually pretty liberal, then when you purchase an asset, oftentimes you can take what's called a Section 179 deduction. What that means is, instead of having to go through this depreciation schedule each year, you can deduct the full purchase price of an asset during the year in which you purchase it. Now, for a small business, that's a really big benefit, because you, instead of having to take, you know, a certain percentage of the cost of your new computer each year, you can deduct the entire cost, which really reduces your taxable income. And so that's what this is referring to, is the Section 179 deduction, and it goes through, and it's they've changed this a little bit. You can tell this is a little bit out of date, but you know, it says you can buy up to $139,000 in equipment, software, and vehicles. I mean, that's quite a purchase. You know, that's quite a bit. Limit of $560,000 in equipment purchases, and the deduction begins to phase out after $560,000. So for most what we call small businesses, this is a really useful tool. Now, if you use some kind of accounting software in terms of preparing your taxes, it's going to automatically ask you, do you want to take the Section 179 deduction? And typically, you're going to say yes. Okay, there may be some times when you don't want to, but most of the time you would want to. It's talking about, this is talking about how much you can write off. This is talking about the purchase of, so this is the reduction in taxes. This is the total amount of equipment. So that is a little confusing there. Okay, so this is your reduction in taxes. This is your actual equipment purchases. Because when you buy your equipment, it's going to subtract from your income, which then means you're going to pay less in taxes, and so that's what this is referring to, this 139. And then it goes through the next, well, actually, okay, I cut out some of those. But, again, really useful, real-world stuff that you might want to check out if you do have some type of small business. Now, the next thing that we're going to talk about is cash flow. And we're going to look at a couple of different definitions of cash flow. One is going to be what we see here, which is called the accounting definition, and the other is going to be the finance definition. So let's talk about the accounting definition first, because this is probably the most popular definition of cash flow. It says cash flow is equal to net profit after taxes. This is typically the bottom line of an income statement, plus depreciation. And, you know, typically this could be depreciation or any other non-cash expense that the company has. Now, let me ask you this. There's a question at the bottom of the screen. It says, why do we add depreciation back to net profit after taxes if we want to come up with the total cash flow, the total cash created by the corporation during a certain time period? Okay, so we want to know how much real cash we actually created. And so why are we adding the depreciation back to help us come up with how much real cash we create? Okay, and depreciation is what kind of expense? A non-cash expense. That's exactly right. We said depreciation was a non-cash expense. So we took depreciation out further up the income statement. We had depreciation expense and whatever it was, but that cash didn't actually leave our company. So to calculate accurately how much cash we created, we had to come up with our net profit, and then we had to add back the depreciation expense that we had subtracted out earlier to come up with the total operating cash flow for our corporation. And so this is the accounting definition. The finance definition is just a little different, and I'm going to ask you in just a second about this, but the cash flow under the finance definition is equal to earnings before interest and taxes. We also called that operating profit back in chapter 3, minus taxes plus depreciation. EBIT minus taxes plus depreciation. Now my question is, how is this different from the accounting definition? There's one item that's in the accounting definition that is not in the finance definition. Or actually, I should say one item that's in the finance definition that's not in the accounting definition. Now remember, the accounting definition, let me go back to it. It was net profit after taxes. So again, you have to think of an income statement and how it's made up. Bottom line of the income statement, plus depreciation. With the finance definition, it's earnings before interest and taxes. We then subtract out income tax. And we add back depreciation. But what's the one thing that's left in the finance definition? Interest. The I here. Interest expense. Interest expense is left in the finance definition. Interest expense is taken out of the accounting definition. Now, the reason for this is, under the finance definition, we're assuming that interest expense, because typically we are borrowing, when we pay interest, we have borrowed money to purchase hopefully some type of equipment maybe for our company. And so the equipment purchase helps us to create cash flow. So what we're saying is interest expense is a very important part of creating cash flow. That's why we're leaving it in here, but we're taking it out in the finance definition. Is one better than the other? No. As long as you're consistent and you use either the accounting definition or the finance definition, it doesn't really matter. I know when I was in banking and was a commercial loan officer, and I'd have a business customer come to me and want to borrow money, I would go through and have to calculate that company's cash flow, because the cash flow is what they were going to use to pay back the loan. And so I have to go through and work my way down to net profit and then determine how much depreciation they were taking. Depreciation to determine the total cash flow created by the company. Then they could service the debt or the loan payments with that cash flow. So both of these will be included on the formula sheet. Although if you're spending a lot of your time studying, I'll go ahead and tell you, don't spend just a lot of time studying and worrying about these two definitions. Okay? I don't think there are any calculations associated with the accounting definition versus the finance definition. Okay? And this gives you an example, but since we're not working any problems, we'll run past that really quickly. And this is, I want to get to this, the financial planning process. Now, this is the very last part of the chapter. And again, this is where later in the semester, this will make a lot more sense to you. Okay, right now, it's a little bit early, so the financial planning process, we really can't do a whole lot with it. So what I want you to know basically is listed here on this slide. Again, we're talking about corporations and how they put together their financial plan. So it says here, the first bullet point, the financial planning process begins with long-term or strategic financial plans that in turn guide the formulation of short-term or operating financial plans and budgets. And then secondly, two key aspects of financial planning are cash planning and profit planning. Cash planning involves the preparation of the firm's cash budget. Profit planning involves the preparation of what's called a pro forma financial statement. And while we're here, let me ask you this. What does pro forma mean? We talk about a pro forma financial statement. That's the word of the day. You need to be able to work that into a sentence sometime during the day. You'll impress somebody. Pro forma simply means projected. So projected income statement. So we're determining, okay, this is 2015. What does our projected income statement look like for 2016? Okay? So you can be talking to somebody today and you can say, my pro forma grades for this semester, it's supposed to be funny, okay? One person laughed. That's I'm really disappointed in all of you. Okay, so pro forma income statement. So you need to know this. And when you take a look at the study guide, which on Canvas, there is a study guide for you to take a look at. When you get to the study guide, it will be very clear the small part of the financial planning process that you need to know from Chapter 4. All right, so are there any questions to this point about Chapter 4? If you go to Canvas, go down towards the bottom of your Canvas homepage, you will see some test information. So there will be a study guide, there will be a formula sheet, there will be some practice questions and solutions. Also remember that for each chapter, there are suggested homework problems and solutions for each chapter. And those are really good preparation for the test. All right, so one other thing, really important. If we're going to start, if you would rather put off the review until next Thursday, then on Tuesday, we're going to start Chapter 5. Chapter 5 is when we're going to start using the financial calculator. Okay? So, typically what I will do is I try to bring, by the way, I'm missing one of these. So if somebody has borrowed one of these, I think somebody maybe in this class borrowed one, if you would return it, please, after class. What I try to do is bring 3 or 4 of these to class, so if you don't have yours or forgot it or whatever, you can use it. But if you haven't purchased your basic $30 BA2 Plus, you need to try to get that this weekend so that on Tuesday we start, you don't get behind on it. Also, if you have one of the larger graphing calculators, you can start using that also. Yes, like one of the TI 80. Yes, that will work. All right, so questions, comments, complaints, other than the temperature of the room? I may have to lecture from the back corner then from now on. All right, everybody have a great weekend. Try to stay warm. Once you leave this room, be safe, and I will see you back here on Tuesday.